Okay, hello again. Um, Today we will learn whether we can afford to wait when we have a losing position. It's a very important lesson. Now, uh, imagine you have a boat. You put a boat in the middle of the ocean, and there are no people on the boat. The engine is not running. Just chaotically, just being thrown up and down by the waves, here and there by the wind, and you come back. You just pin its position by something linear. For example, its GPS position, and you come back in a day. 24 hours later, you come back, you measure where this boat has moved. Okay? And you measure the distance from its initial GPS position to its new position 24 hours later. Okay? On average, it's not guaranteed this will be the case every time you do this experiment, but on average, you will find out that the boat will be further away from your initial place you put it if you wait longer. So in 24 hours it will be on average, for example, 5 miles away or 10 miles or whatever. It will vary. It will vary according to the wind, to waves and so on. But you will learn that if you wait a week, on average, it will go further away from the initial point than if you wait only 24 hours. Okay? Of course, there will be cases in this experiment of tens and hundreds and thousands of trials doing this, that in a week the boat is closer to the initial point, to the initial place, than in 24 hours. There will be even cases, if you do it millions and billions of times, that probably the boat will be on the same spot when you come 24 hours later or in a week later, because it will be drifting up and down and you find it there. But on average, the longer you wait, the further away the boat will go. So, can the markets be predicted? No, the markets cannot be predicted. Is there something to follow? A trend or something? The answer is there is no trend. Trend implies something trending, something, some tendency. Okay, some tendency in the future. You cannot predict the future when it comes to markets. Is there such thing as trend? No, there's no such thing as trend. Okay, there's no such thing as trend. Big players bought here, and that's the support level. and such BS or resistant level, and the big players such idiots that they cannot change their mind. Okay, they bought there, and when they bought there, they are so stupid they cannot sell what they bought because they are dumb. They're just dumb. They do something, and 6 months they don't do anything else because they're idiots. Okay? No, there is not such thing as support into resistance. There is no such thing as overbought and oversold. Okay? No such thing as overbought or oversold. For every contract, or when it comes to futures or options, or for every lot when it comes to FOREX, or for every, I don't know, share, when it comes to shares, there is a buyer and a seller. And they're always 50-50, the buyers and the sellers. It doesn't matter if all the retail traders like you and me are buying, and only one the other party, okay, is the seller. So it doesn't matter whether one party is selling to all the others and all the others are buying. It doesn't matter at all, because the number of contract is 50-50. So if the party which is selling is so strong, it doesn't matter whether all the weak ones are buying or selling. It doesn't matter. They don't move the market. The market is moved by the market mover. Okay? So, there's no such thing as trend. And if you see, for example, euro dollar, in a 1 minute chart, and here you have about 6 hours, okay, 4 hours or something like that, of trend, of movement, and you have something here, something level or whatever. If you enhance, if you make this period bigger, and every bar, which is the same thickness as you see, every bar is the same thickness, and every bar is the same thickness, and the number of bars is always the same, because the trading platform is doing that, just the computer is putting that. But it represents not 1 minute, but now it represents 5 minutes. It's a 5 minute, okay, 5 minute period represents what? You will see that here we have about, I don't know, 24 hours. It's a 24-hour period. And now we see something like, okay, like a trend. Yeah, trend. And if you put it on a 15-minute chart or bar, one bar is 15 minutes, then we have 3.5 days, trading days here, 3.5 trading days. So we have some trend. Wow, it's going up. Okay, the billionaires are buying here, and they are keeping their positions so that we, the poor, can buy and other billionaires putting more money over these billionaires' money, so the market can pull up and make us well off. Okay, it's a charity. The market is a charity. Okay, so it's 15. One bar is 15 minutes, and it's up. And surprise, surprise, when we go to 30 minutes, wow, the trend, which is our friend, now behaves like a schizophrenic. Okay, like a schizophrenic. It was up, it was, at first it was level, then it was up, then it's level, but we have a double S here. Yeah, a double S. Yeah, we have a squatter here. Okay, so we are going now to 1 hour chart. This is 1 hour chart, and we are down this time. We are level, we are up. We had such a levatory position, and now we are going down. Okay, and that's 1 hour. 1 hour. Okay, this is about, I don't know, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Okay, 12 trading days. 12 trading days. And now it's a 4 hour chart. 4 hour, one bar is represents 4 hours, a 4 hour period. Then we are up again. Wow. Or maybe up and level and down, I don't know. One chart represents 1 day. That's I think a year and yeah, a year, not yeah, more than a year is that, and we are up again. Okay, you got the point that you got the point that you changed the period, the trend changes, but what is more important is that if we put if you put lines, horizontal lines, just let us put a horizontal line here and a horizontal line here. Okay, a horizontal line here, horizontal line here. If we, this is a 5-minute chart, okay? If this is a 1-minute chart, this is a 5-minute chart, this is a 15-minute chart, one bar is 15 minutes. You see how the two lines are going closer and closer. This is a 30-minute chart, this is a 1 hour chart, this is a 4 hour chart, this is a 1 day chart, 1 week chart, 1 month chart. One bar represents 1 month. Okay, so the same way as the period is changing and is going up and up the period, here the computer just smashes the chart, so you can see all the tops and bottoms to see the whole chart for this number of bars. The number of bars is always the same, and the computer just compresses the chart, and by compressing it you can see that the pips here are compressed. So this this the the distance between our two lines is 67 pips. Okay, 67 pips. So the whole screen is 67 pips. For this instrument, for this particular period of time, is 67. If we go 5 minutes, one bar is 5 minutes, you see 15 minutes, 30, an hour, 4 hours is one bar, a day, you see when we go one bar is one day, then from the top of the screen of the chart to the bottom of the it's about uh, 1,465 or something like that. Let's say that it's 1,400 pips. Okay, that's the only difference. So the more you wait, the boat, the more time the boat spends in the more time the boat spends in in um, in open ocean, the bigger the probability that the boat will move more on average. So the longer you wait here, the more probable that the market will move more. So can we afford to leave our positions, go behind our back and being losing positions and wait? Can we afford that? If we wait, then the chances that our positions will drift away more and more and will be losing more and more is bigger and bigger. So if we are not masochists, if we don't like and take pleasure in losing money, if we do not take pleasure in giving away money, okay, then we cannot afford to wait when we have a losing position. Okay, we cannot afford to wait. We do not wait. We close the losing position, okay? And what instrument we trade? We trade instrument which has tighter spread, a tighter spread compared to the fluctuations of the market. So we need volatility. What we do not need is disorder. We wait for order, but that will be in the next videos. In the next video, we'll talk about order and disorder. And when it comes to volatility, we embrace, we like, we cherish volatility. We are not scared by volatility, because volatility is the amplitude of the moves, okay? The amplitude of the moves. The height of the bars, that's volatility. And people think that volatility is when the, the S hits the fan and the fan is very big and the RPM are very high and the S is really, really big. And everything in an instant is covered with S. Okay? So we cherish volatility. Volatility and disorder are two different things. Volatility is the amplitude and disorder is something else, and we'll talk about it the next time. Bye. Subscribe if you have not subscribed yet. Like, comment, of course, if you want to tell me something. I read the comments, and do not be ashamed and do not beat yourselves for donating money. Donation is a good thing. Bye.